All right. Little bit of compression today. After doing kind of a high and low off the market open. Basically, options were overpriced. Event vol for today was sky high, so the implied moves were excessive, and price action after peaking at the high and the low. Basically, we just saw everything get short strangled into close, with the bulls losing a little bit of ground at the very end of the day. So we did get that. We did get that close at 69.40. That is below the 69.50 level. Obviously, that level still has like a pinning effect going into Monday, but Monday has a pretty significant amount of negative gamma, and volatility was up on the day a little bit. So bulls may have or bears may have a little bit of an edge going into next week. Obviously, supportive gamma is non-existent on the 0 day or the SPXW contract, and there's really not a lot of supportive gamma out on the monthly contract either. Oh, markets closed Monday. Sorry, Tuesday. Going into Tuesday. I keep thinking Trump canceled it. I can't help it. Yeah, we've got some fairly distributive price action following the retest of the trend yesterday, or the attempted retest. We didn't actually even retest the trend back to the upside that we failed on Tuesday. And this does open a leg down to our prior low, or more importantly, down to like 68, 67, which would be the next like projected low. Off another leg down. I will say that with earnings coming up next week, if we do see that test in the early part of next week, down here around 68, 67, I would expect a bounce. I would expect people to pile into the short dated earnings vol, and like earning volatility is obviously going to rise into tech earnings on equities, and that's going to push index vol down, which is going to open up like a brief window where people are probably going to go like long equity, short index vol, um, at least into the earnings themselves. Past earnings, all that vol is going to crush out, and that's going to be really really good or bullish for index vol. But we're not there yet, so let's see what happens with this. And then we got yields at the top end of the curve moving up pretty sharply, with the 10-year back above 422, the 20 and 30 pushing out above 48. A little bit of movement in the twos and fives, but the front end kind of tightening up a bit. So not too much cash demand for this OPEX. It's not like a big cash demand OPEX, but um, we will see the rest of the effect of that cash demand Monday with the end of SL, or Tuesday with the end of SLD, and the Tuesday pre-market. Silver pulling back a little bit today, which was kind of indicated by the insane move up yesterday. So copper also pulling back. Gold not so much. It's getting a little weakness, falling under 4,600, but still kind of sticking around there. So obviously the chop starts to push back above 4,600. Gold's probably good for another leg up, but oil rose a little bit today, which is interesting because it's been just fucking dumping all week. Correlation continued to turn up. Obviously, today's expiration will see a big breakdown in correlation, especially on the 1 month, as we get all the leap options on all the equities across the market falling off, and all of that will reposition. However, much of it will reposition, but this can also be a time where you see a lot of sector rotation. So it may be that we continue to see correlation break down. 3 month correlation rising pretty steadily as well. Bond volatility is still just falling off a cliff. Carry leverage moving up to 10.13x, so pushing out above 10x now, to new all-time highs. We did see a little bit of a pullback on the front end. Forward yield on volatility is still around negative 13%, and the 10-2 continuing to slide. Silver haircut on the carry profitability is at negative 1.23%. that can pull down a lot more as profit, like the P&L and like short-term P&L increases, or day over day P&L increases on the carry. But carry total cumulative leverage still at about negative 15.85% cost to carry. So quite a lot of pressure on the carry trade right now. This is carrying something at negative 15% is really not a great deal. Skew turned around a little bit today. 20 day movers kind of pushing up above 50s yesterday. We probably saw that snap back today with Dow falling. However, Russell still posted some gains on the day. I will say that, these periods with your 50-day movers over 200-day movers are generally fairly short, and a lot of this may have just had to do with the dispersion trading into the leap expiry. And now that the leap expiry is over, we might see some of these, we might see some of this breadth collapse, pull back and normalize a bit. Fed fund futures, I mean, Jan expectations are falling near zero, or June expectations are falling near zero. 10-2 moved up about 5% today. And the SOFR IORB spread picked up 1 point positive. So we had a few days of negative. Now we're back to a little bit of a negative spread there over IORB rates. However, SOFR futures at 3.67, so those are still holding a steady 2 points above. But SRF usage low, so cash demand not very high. We're not getting a very good test of liquidity yet. Again, Monday or Tuesday morning SLD finalization, we might see that pop a little bit more. Obviously, as that short-term funding becomes more expensive versus the interest rate on reserves, you end up in a scenario where short-term cash is overpriced and people start to sell equities to get funding. And so, that's what we care about. Correlation turned up second day in a row now. And we did get a bump in volatility day over day. So, if we continue to see correlation rise into next week, that opens up some room for index volatility to pop up a little bit. However, again, pre-earnings, I wouldn't expect it to pop a lot unless we get like geopolitical or macro news that's really bearish. Leverage rising, and the market kind of stabilizing, dropping. So this could be, we're starting to see put leverage picking up. Generally when you get a bunch of uptick in leverage from these levels, you start to see the market sell off a little bit. That's kind of what we saw back in November. Other periods where you see that is like back here in December. Leverage really was very, very high, but that ended up starting to break down, and then the market fell. But lastly, take a look at technicals. Yesterday we got the high test of the trend. We failed. Today we retested the trend, failed again, closed below the 69.45 level, which is December's high. And then we still need to see like kind of relevant downside tests. It looks like going into Tuesday, the 20 MA will be roughly around 69.20. So that'll be the key downside level to watch, to confirm the rejection off the upper part of this trend, and then a failure of the lower trend line. Below that, we'd be looking at like 68.82, and then we'd be looking down here at like 68.30 at the 50-day moving average. The next really important technical level to the downside beyond that is like 67.20, which was the December low. Below that, you start to open up much larger moves towards like the November low, which is around 65.21, and would probably be a retest of the 2019, like the 1929 trend. So that's very, very, very long-term trend, but it did have some relevance back in 2024. We've mean reverted to it a couple of times, but over most of 2025, we grew out past it. Yeah, those are the levels I would watch, and that like 67.20 tests to the downside would be also roughly the 2022 trend off of the 21 bull market. And so, yeah, I think that's everything. So thank you guys for tuning in, as always. I hope all of you have a great extended weekend, and I will see you, I don't know, like next week for stuff. But Monday, Well, I guess we might talk Monday before market, like for the Zillionaire stream. So maybe we'll do that. GG. Catch you guys later. Peace.